IS 34 Interim Financial Reporting. IS 34 specifies the minimum content required for interim financial reports and establishes principles for recognition and measurement during interim periods. An interim period is any reporting period shorter than a full financial year, such as quarterly or half-year reporting. IS 34 requires a condensed set of financial statements, including a condensed statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and selected explanatory notes. The purpose of interim reporting is to provide timely updates on an entity's performance and financial position, supporting users in assessing progress and forecasting annual results. IS 34 allows entities to omit certain details normally required in annual reports, provided the interim report includes all information necessary to explain significant events and transactions since the last reporting date. Measurement principles used in interim periods must be consistent with annual accounting policies, ensuring comparability and preventing artificial smoothing of results. The standard emphasizes that interim reporting should reflect the economic activity of the period without undue deferral or anticipation. IS 34 also requires disclosure of events and transactions that are significant to understanding changes in financial position and performance since the last annual reporting period. Examples include seasonal fluctuations, changes in accounting estimates, impairments, unusual items, or shifts in capital structure. Because interim periods are shorter, IS 34 recognizes that certain expenses and revenues may not be evenly distributed throughout the year. However, entities must avoid allocating annual costs arbitrarily. Instead, they must apply the same accounting policies as in the annual financial statements unless a new standard mandates change. The emphasis on consistency ensures that interim results can be meaningfully compared with prior periods and full-year expectations. IS 34 also requires entities to explain the nature and financial impact of significant changes, enhancing transparency. Overall, the standard promotes timely communication, enabling stakeholders to monitor performance trends, evaluate liquidity, and assess emerging risks. Interim reporting is therefore an important mechanism for enhancing market efficiency by offering more frequent, relevant information between annual reporting dates. IS 20 deals with the accounting treatment and disclosure requirements for government grants and assistance. The topic explains that a grant should only be recognized when there is reasonable assurance that the entity will comply with any attached conditions and that the grant will be received. Grants related to income are intended to subsidize operational expenses, and therefore they must be matched with the costs they are intended to compensate. These grants are recognized in profit or loss over the same period as the related expenditure. Grants related to assets, often referred to as capital grants, must be recognized over the useful life of the asset they relate to, ensuring alignment between the grant benefit and asset consumption. IS 20 permits two policies for asset-related grants, either deducting the grant from the carrying amount of the asset and depreciating the net amount, or recognizing the grant as deferred income and releasing it systematically into profit or loss. The notes highlight that consistent policy application is essential to maintain comparability and transparency. The topic prepares candidates to justify grant recognition timing and policy selection in scenario-based exam questions. The topic further emphasizes that IS 20 requires clear disclosure of both the nature of government grants and the extent of government assistance received. Entities must provide information that helps users understand how grants have affected the financial statements, including any unfulfilled conditions or contingencies attached. The choice between the deferred income method and the netting off method must be applied consistently and disclosed as part of accounting policies. IS 20 also interacts with other standards, particularly IS 16, as the treatment of asset-related grants directly affects asset carrying amounts, depreciation charges, and potentially revaluation calculations. The topic highlights that grants should not distort reported performance. Instead, the systematic recognition rules ensure that grants serve their intended purpose by offsetting related costs or providing appropriate support for capital investments. Candidates must be alert to situations where the conditions of a grant require repayment, in which case the grant is reversed and treated as a liability. Overall, IS 20 aims to present a fair representation of government support while maintaining faithful depiction of asset values and operational costs. 4. IS 23, Borrowing Costs. IS 23 governs the treatment of borrowing costs, defined as interest and other costs incurred in connection with borrowing funds. The topic explains that entities must capitalize borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset, an asset that takes a substantial period of time to become ready for intended use or sale. Examples include major construction projects and large-scale manufacturing assets. Capitalization ensures the asset's cost reflects all expenditures necessary to prepare it for use. Borrowing costs not related to qualifying assets must be expensed immediately in profit or loss. The topic emphasizes that identifying qualifying assets requires judgment, and entities must apply consistent criteria. Capitalization begins when expenditure is being incurred, borrowing costs are being incurred, and activities necessary to prepare the asset for use are underway. Capitalization pauses during extended periods of inactivity and ceases when the asset is substantially ready for use. These principles ensure the cost of a qualifying asset reflects the economic reality of financing its construction. The topic notes that IAS 23 promotes comparability by requiring capitalization instead of allowing entities to choose between capitalizing or expensing, as was the case under some older frameworks. Capitalization can significantly affect the timing of expense recognition and reported profitability, especially for entities with large development or construction activities. The standard also interacts with IAS 16 for PPE and IAS 38 for intangible assets, as both may constitute qualifying assets. Borrowing costs capitalized are added to the asset's carrying amount and subsequently depreciated or amortized over its useful life. IAS 23 requires disclosure of the amount of borrowing costs capitalized and the capitalization rate used, ensuring users understand the financing elements embedded within asset values. The topic reinforces that capitalization should reflect genuine costs incurred to construct or acquire qualifying assets, and must not be used to artificially defer expense recognition. Proper application ensures financial statements reflect both the true cost of long-term asset development and the financing strategy of the entity, providing users with better insight into capital investment decisions and long-term performance. 5. IAS 40, Investment Property. IAS 40 addresses the recognition and measurement of investment property, which is defined as property held to earn rentals, for capital appreciation, or both. Investment property is initially recognized at cost, including transaction costs such as legal fees and professional valuations. After initial recognition, entities may choose between the cost model and the fair value model. Under the cost model, investment property is measured in the same way as PPE under IAS 16, meaning it is carried at cost less accumulated depreciation and impairment. The fair value model, however, requires entities to remeasure investment properties at fair value at each reporting date, with all gains and losses recognized in profit or loss. This model reflects real-time market fluctuations and therefore gives users timely information about property values, especially for entities heavily involved in property investment. The topic emphasizes that once a model is chosen, it must be applied consistently unless the entity changes its overall accounting policy. The fair value model is often preferred due to its direct reflection of market conditions and its effect on profit, but the topic stresses that fair value must be reliably measurable. For properties where fair value cannot be reliably determined on a continuing basis, the cost model is required. IAS 40 also provides guidance on transfers into or out of investment property, such as when owner-occupied property becomes investment property or when property held for sale becomes part of inventories under IAS 2. Any transfer into the investment property category using the fair value model requires remeasurement to fair value at the date of transfer, with changes recognized appropriately depending on the prior classification. The topic reinforces that investment property must be distinguished clearly from owner-occupied property and property held for development or sale. Entities must disclose their measurement bases, methods for determining fair value, and assumptions used. IAS 40 ensures transparent reporting by aligning the accounting treatment of investment property with its underlying economic purpose, income generation or value appreciation.